For more than a century, utilities dominated energy markets. They did so by owning centralized assets and earning regulated returns. That model wasn't accidental, it was effective. But it was effective for a specific environment. That environment is changing. The future of energy will not be defined by who owns the most infrastructure, but by who can coordinate complexity across increasingly distributed systems. This episode is not about disruption or replacement. It's about understanding where value accumulates as systems evolve. And that is why the most valuable energy companies of the future won't look like traditional utilities. Utilities dominated because the conditions demanded it. Energy generation was centralized. Infrastructure was massive and expensive. Economies of scale mattered more than flexibility. Regulated returns provided predictability. Slow expansion matched long infrastructure timelines and capital constraints. This model was not flawed, it was optimized. Stability, scale, and capital efficiency under regulation created enormous value for decades. Understanding why utilities won is essential, because this transition is not about failure, it's about environmental mismatch. Utilities optimized for what mattered most in their era: maximum reliability across vast territories, efficient deployment of expensive centralized infrastructure, long-term stability over short-term flexibility, regulatory compliance and stakeholder trust. These choices weren't cultural preferences. They were responses to genuine constraints. Energy had to be centralized. Capital requirements were massive. Reliability mattered more than speed or iteration. This alignment between environment and organizational design is what created utility dominance throughout the 20th century. That alignment no longer holds. Energy assets are becoming smaller, more numerous, and closer to consumption. Software increasingly mediates physical infrastructure and operational decisions. Customers are becoming active participants, not passive endpoints. At the same time, market dynamics move faster than regulatory cycles. None of this invalidates utilities, but it changes where advantage forms. The environment now rewards flexibility, coordination, and responsiveness, not just scale and permanence. Historically, value concentrated where assets were owned and operated. That logic is changing. In many modern systems, value migrates toward coordination, not ownership. We've seen this pattern before, in software, in logistics, in finance, in communications. The most valuable companies don't own everything. They orchestrate how many things interact. Energy is now entering this same transition phase. When people say energy companies will look like software companies, it's often misunderstood. This is not about selling apps or building dashboards. Software is a shape. It's an organizational logic that prioritizes coordination, iteration, and adaptability. Companies shaped this way behave differently, even when managing physical infrastructure. They prioritize flexibility over permanence, optionality over scale, and position over ownership. That organizational shape is becoming more valuable than the underlying assets themselves. Utilities don't struggle because they lack intelligence or ambition. They are constrained by design. Regulatory frameworks reward stability over experimentation. Organizational structures are built to manage long-lived assets. Planning horizons span decades. Capital allocation favors large physical investments. These constraints are not failures. They are features. They are rational and necessary for utilities' critical role. But they make adopting coordination-optimized organizational shapes extremely difficult. This tension is structural, not cultural. This transition is often mischaracterized as disruption. That framing is misleading. Utilities will remain essential. They will continue managing critical grid infrastructure and ensuring baseline reliability. What emerges alongside them are companies that coordinate assets, behavior, and information across boundaries. Utilities were never designed to manage. The result is coexistence. The most valuable energy companies will increasingly sit around utilities, adding capabilities rather than replacing infrastructure. This is addition, not elimination. Traditional valuation logic is asset-based. Value ceilings are determined by owned infrastructure. Growth is tied to capital deployment. Returns are governed by regulation. Coordination-based valuation works differently. Network effects create nonlinear potential. Growth decouples from balance sheets. Returns are driven by position rather than ownership. Markets don't just price assets, they price optionality, scalability, and adaptability. That's why these companies are valued differently. This transition is not unique to energy. It follows a familiar path seen in other infrastructure sectors. First, value concentrates in centralized assets. Then assets become smaller and more distributed. Information layers mediate operations. Finally, value migrates toward coordination. This doesn't happen overnight. It doesn't happen evenly. But directionally, it's difficult to reverse. Energy is now moving through this same sequence. Early in these transitions, the signals are subtle. Traditional players still dominate absolute revenue and asset metrics. New entrants look small by comparison. Market share appears narrow. This visual mismatch creates natural skepticism. But value migration always looks unintuitive before it becomes obvious. Early asymmetry is a feature of these shifts, not evidence against them. This entire VPP series has focused on how value forms in modern energy systems, not by isolating technologies or policies, but by understanding structural evolution. The key shift is reframing the question. From what technology wins to where does value accumulate? Virtual power plants are not the endpoint. They are one expression of a broader movement toward coordination alongside infrastructure. There are real implications of this transition: how companies should position themselves, where capital should flow, how organizations should be designed. But these implications depend heavily on context. They are not universal rules, and they are not appropriate for public discussion. So we stop here, at the level of direction, not execution. Understanding where systems are heading matters. The path depends on your position, resources, and constraints. TaBIS focuses on identifying where value will concentrate before consensus forms, not by predicting winners, but by understanding how systems fundamentally reshape themselves. This perspective matters long before it becomes obvious to broader markets. Durable competitive advantage begins with seeing transitions early, when positioning is still possible and capital hasn't already priced in the shift. TaBIS focuses on three things: strategy differentiation, understanding which approaches compound over time; systems-level analysis, the institutional and temporal layers models miss; capital allocation edge, knowing where to deploy resources when complexity matters. If you're building, investing, or allocating capital in energy infrastructure, this lens matters more than any single forecast. That's the TaBIS discipline. See you next time.